Meet Dave. He's been diligently saving and investing his money for years. But today he's got a problem. His roof just sprung a massive leak, and the contractor handed him a bill for $60,000. Fortunately, Dave has plenty of money sitting in his investment account, so his first instinct is the most obvious one: click sell on some of his most successful stocks to cover the repair. But doing that right now is actually a trap. The moment Dave clicks sell, the government steps in to impose a significant penalty on his profits. It's a frustrating reality of investing. The wealth you see on your screen isn't entirely yours to spend yet, because a large chunk of it is instantly deducted for taxes the moment you cash out. To understand why, you have to look at how the government calculates the tax on a stock sale. The amount they take depends entirely on how much you earn from your daily job. Right now, Dave is at the peak of his career and earning a great salary. Because he has a high income, any stock he sells today is subject to the maximum possible tax penalty. This chart shows exactly how the math works. Think of Dave's high salary like a tall, solid column. When he sells his stocks, those profits are stacked right on top of his regular earnings, pushing his total income dangerously high up into a red, heavily taxed zone. But Dave's situation is about to change. He plans to retire in exactly 2 years. When he stops working, that tall pillar of regular salary completely disappears. Without that high income pushing it up, the exact same stock sale drops safely into a green 0% tax zone. This creates a massive conflict. Dave has a perfectly clear window to sell his stocks entirely tax-free in 2 years, but he needs the $60,000 to fix his roof today. This is where a specific financial tool comes in to solve the problem. It's called an investment or margin loan. The golden rule to remember here is that you do not actually have to sell your stocks to get cash out of them. Instead, Dave goes to his bank investment advisor. He leaves his stock shares safely locked away in his account as a guarantee. In return, the bank or custodian like Charles Schwab or Goldman Sachs hands him $60,000 in cash. Because Dave didn't actually sell or trade away a single share of his stock, the government doesn't see anything to tax. He has successfully acquired the exact funds he needs today without losing a single penny to the IRS. Dave takes that borrowed cash and fixes his roof immediately. Now, the bank or custodian isn't doing this for free. For as long as Dave holds on to their money, they charge him a small yearly fee called interest. Dave happily pays the small fee and waits patiently for the next 2 years while his stock portfolio remains in the market. 2 years pass. Retirement day arrives. Dave turns off his office light for the last time, and his regular work salary officially stops. His total income has now plummeted, meaning he has finally entered the green 0% tax zone. With the tax threat gone, Dave clicks sell on enough of his stock to cover his debt and hands that money straight back to the bank to close the loan. By using the loan to float the cash, Dave successfully paused time. He delayed his stock sale until the precise moment in his life when it cost him absolutely nothing in taxes. But looking back, was paying the bank's interest fee for 2 years really better than just paying the taxes on day one? This side-by-side comparison shows exactly what happens to the money. On the left is path A, selling early. A massive chunk of Dave's wealth is carved straight out to pay the taxes. Because that money is gone, he also completely misses out on the 2 years of stock growth that cash would have earned him. On the right is path B, taking the loan. Dave's wealth continues to grow undisturbed for the full 2 years. At the end, he loses only a tiny sliver of money to pay the bank's interest fee, leaving him visibly wealthier than path A. The math makes the decision completely straightforward. The small cost of borrowing is completely eclipsed by the massive financial savings of avoiding taxes and staying invested in the market. It proves a reliable rule for managing wealth. Paying a little bit of interest is frequently mathematically superior to paying a giant tax bill. Borrowing money gives you tremendous control. An investment loan gives you time to buy. Before you blindly sell your successful investments for cash, check your future timeline. Look ahead to see if a year with lower income and lower taxes is waiting for you. With a little planning, an investment loan acts as the perfect bridge, carrying your wealth safely over high taxes to a more profitable time to sell.